You make $100,000 a year, 6 figures. The number your teachers said would mean you made it. The number your parents still think guarantees a nice house, 2 cars, and a comfortable life. So you open Zillow, and suddenly every decent home is $550,000. The kitchen hasn't been updated since 2008. The roof looks tired. The listing says cozy, which is real estate code for you will feel the walls breathing. But the bank says you're approved. Your agent says you're in a great position. Your friends say, if you don't buy now, you'll be priced out forever. So what's the problem? The problem is this: you can qualify for far more house than you can actually afford. And if you don't understand the difference, you're about to lock yourself into a financial life you hate. Today, we're doing what the real estate industry quietly hopes you never do. We're calculating what you can really afford, not what the bank approves, not what Zillow normalizes, not what your ego wants, what your math supports. Let's start with the illusion. Most lenders use the 43% debt-to-income ratio as their ceiling. That means your total debt payments, mortgage, car, student loans, credit cards, can eat up 43% of your gross income, and they'll still smile and say, "Congratulations." 43%, almost half your income. That's not affordability, that's maximum survivable pressure. There's a quieter rule in personal finance called the 28% rule. It says your housing costs alone, mortgage, property taxes, insurance, HOA, should stay under 28% of your gross income. That's comfort, that's breathing room. Now let's run real numbers. You make $100,000 a year. That's $8,333 per month gross. After taxes, roughly $6,200 depending on state. Using the 28% rule, your total housing payment should stay around $2,333 per month. Not the mortgage, everything. Now let's reverse engineer that. Assume 6.5% interest rate, 10% down, average property taxes, standard homeowners insurance, PMI, because you didn't put 20% down. At today's rates, a $500,000 house with 10% down gives you principal and interest. Approximately $2,850. Property taxes, approximately $500. Insurance, approximately $200. PMI, approximately $250. Maintenance, 1% annually, approximately $415. Total real monthly cost, approximately $4,215, not $2,850. $4,215. That's 68% of your take-home pay. That's not a home. That's financial claustrophobia. So what house can you actually afford? To keep total housing near $2,300 per month at current rates, you're looking at something closer to $325,000 to $350,000. Not $500,000. That's a $150,000 to $175,000 difference between what the bank approves and what your life can handle comfortably. And here's where people break. Because $350,000 in many markets doesn't look like the life they imagined at $100,000 income. This is the moment where ego fights math, and math always wins. But we're not done, because the mortgage is only the beginning. The mortgage payment is the part they show you. Everything else is the part that breaks you. When people calculate affordability, they stop at principal and interest. That's the number the lender highlights. That's the number the listing site estimates. But ownership isn't a payment. It's a system of ongoing liabilities. Let's keep using the $500,000 example from part 1. You already saw the $4,215 real monthly cost. Now let's zoom out, because that number assumes nothing goes wrong. Something always goes wrong. Here's what actually happens after you move in. First, maintenance isn't optional. The 1% rule says budget 1% of the home's value per year for upkeep. On a $500,000 house, that's $5,000 annually. That's if nothing major fails. Roof, $15,000 to $25,000. HVAC, $7,000 to $12,000. Water heater, $1,500 to $3,000. Foundation issue, 5 figures easily. These aren't rare disasters. They're normal life cycle events. Houses age, systems break, materials deteriorate, and unlike renting, you can't call a landlord. Second, property taxes never stop. If your property tax rate is 1.5%, that's $7,500 per year on a $500,000 home, $625 per month. And here's the part most buyers ignore: property taxes rise. Usually every year. You can refinance your interest rate. You can't refinance your tax base. Third, insurance is getting aggressive. In many states, homeowners' insurance premiums have jumped dramatically over the past few years. Storm exposure, fire risk, flood risk. Reinsurance costs. What used to be $1,200 per year is now $2,500 to $4,000 in some markets. That's another $200 to $330 per month. And insurers can drop coverage, which forces you into more expensive policies. Fourth, opportunity cost. This is the silent killer. If you put $50,000 down and spend $4,200 per month on housing, that money isn't investing elsewhere. Let's say instead you bought a $350,000 home and invested the difference, the lower payment gap of roughly $1,800 per month, into index funds earning 7 to 8% long-term. Over 10 years, that gap could compound into 6 figures. Stretching for the bigger house doesn't just increase risk, it reduces optionality. Now let's talk about lifestyle compression. At $100,000 income, after taxes, you have roughly $6,200 per month. If housing consumes $4,200, you have $2,000 left. From that $2,000 you still need groceries, utilities, transportation, car insurance, health insurance, phone, internet, gas, entertainment, clothing, travel, retirement, investing. If you're contributing 15% toward retirement, which you should be, that's $1,250 per month pre-tax. Suddenly, the margin gets thin. Very thin. This is how people become house poor. On paper, they look successful. In reality, they're one broken transmission away from a credit card spiral. Now compare that to buying at $350,000. Let's say total monthly housing lands around $2,600 to $2,800. You suddenly have $1,400 to $1,600 extra breathing room every month. That's full retirement contributions, emergency fund growth, investment capital, or simply lower stress. Financial comfort isn't about maximizing what you can borrow. It's about maximizing what you can keep. And here's something nobody in real estate marketing will say out loud. The bigger the house you buy, the more your future becomes fixed. Your job options narrow. Your risk tolerance drops. Your ability to pivot shrinks. Because now you must protect the payment. Most people think affordability is about income. It's not. It's about stability. Two people can both make $120,000 a year. One can comfortably afford a $450,000 house. The other can't safely afford $300,000. Same salary, completely different risk profile. Here's why. First, geography rewrites the math. A $400,000 house in a low-tax state with modest insurance costs might run you $2,600 per month all in. That same $400,000 house in a high-tax state with elevated insurance premiums could cost $3,400 plus per month. Same price, different burden, and the burden compounds every year. Second, debt load silently destroys buying power. Let's say you make $100,000, but you also have $450 student loan payment, $600 car payment, $150 credit card minimum. That's $1,200 before housing. Lenders will still approve you near their 43% DTI ceiling, but your personal cash flow doesn't care about approval formulas. Every $500 in fixed monthly debt reduces safe home affordability by roughly $75,000 to $90,000 at current rates. Yet most buyers calculate mortgage affordability in isolation. That's like measuring how much weight you can lift without factoring in the backpack you're already wearing. Third, life stage risk. Early career, income volatile, promotions uncertain, layoffs more common. Dual income household. What happens if one person steps back for kids? Commission-based income. A downturn can cut earnings 20 to 40%. Mortgage payments don't flex. They don't care about your bonus cycle. They don't adjust during slow quarters. Stretching into a house when income is rising fast can work. Stretching when income is flat or unpredictable is dangerous. Now let's talk about something almost nobody models properly: income concentration risk. If 80% of your household income depends on one job, in one industry, in one region, that's fragility. Owning a house amplifies fragility because housing is a fixed, illiquid asset. If you lose your job, you can't sell a kitchen cabinet to make a partial payment. You either make the mortgage or you don't. This is why the same $500,000 house feels affordable to a tenured software engineer at a profitable company, and terrifying to a self-employed freelancer earning the same annual income. Risk tolerance isn't about personality, it's about structure. Now let's zoom out further. The hidden cost nobody talks about is mobility. When you rent, your exit cost is low. When you own, your exit cost can be massive. Agent commissions, 5 to 6%. Closing costs, market timing risk, price fluctuations. If the market dips 5% and you need to move within 3 years, your equity can evaporate. Buying only works financially if you stay long enough, the market doesn't significantly decline. Your income remains stable, major repairs don't cluster early. That's a lot of ifs. This is why break-even timelines in many markets are 7 to 10 years right now. Less than that, and renting often wins financially. But renting doesn't feel like progress. Buying feels like adulthood. That emotional pressure pushes people into leverage they don't fully respect. And leverage is powerful. It magnifies gains. It also magnifies mistakes. Now here's the uncomfortable truth. Most people don't overbuy because they ran the numbers wrong. They overbuy because they benchmark against peers. Your friend bought a $600,000 house. Your coworker upgraded. Instagram normalizes bigger living rooms. But you don't know how much debt they carry, whether their parents helped, how stressed they are, whether they're saving for retirement. Affordability is personal, not social. Let's remove emotion. No ego, no social pressure, no Zillow fantasy scrolling at midnight. Just math and structure. Here's the framework. Step 1. Start with net income, not gross. If you make $120,000 per year, that sounds strong. But after federal taxes, state taxes, Social Security, Medicare, and benefits, you might take home around $7,200 per month. That's your real constraint. Everything flows from this number. Step 2. Lock in non-housing essentials. Before housing, you should already be allocating 15 to 20% to retirement, health insurance, transportation, food, utilities, minimum debt payments, basic lifestyle expenses. If retirement investing alone is $1,500 per month and your fixed non-housing costs total $2,500, you've already committed $4,000. Out of $7,200, that leaves $3,200, not $7,200. Now we apply a safer housing ceiling. Instead of 43% of gross, aim for 25 to 30% of net income for total housing cost. Yes, net. This is conservative. That's the point. If you take home $7,200, 30% equals $2,160. That's your target maximum all-in housing payment. Mortgage, taxes, insurance, HOA, maintenance buffer, everything. Now reverse engineer price from there. At current rates around 6 to 7%, with 10 to 20% down, a $2,100 to $2,300 total housing budget likely supports something around $325,000 to $375,000. Even if you qualify for $550,000. That gap is the illusion. Step 3. Stress test the payment. Ask 3 questions. If one income disappears for 6 months, can we survive? If a $15,000 repair hits in year 3, can we handle it without debt? If the market drops 10%, would we still feel stable staying put for 7+ years? If any answer is no, you're stretching. Step 4. Protect mobility. If buying eliminates your ability to change jobs, move cities, start a business, take a career risk, you're not buying a house, you're buying a constraint. Wealth isn't just net worth, it's flexibility. Step 5. Compare against the renting alternative honestly. If renting costs $2,200 and buying costs $4,000, that $1,800 difference invested monthly at 7% grows to roughly $310,000 in 10 years. Ownership builds equity, but cash flow invested builds optionality. Sometimes the smaller house wins. Sometimes renting wins. Sometimes waiting wins. The goal is not to buy as soon as possible. The goal is to buy when the numbers align with your long-term wealth trajectory. Now here's the psychological shift that matters most. The real estate industry sells maximum approval. Smart buyers calculate maximum comfort. Those are not the same number. Approval asks, how much debt can you carry? Comfort asks, how much life do you want outside your mortgage? If housing eats 60% of your take-home pay, you'll feel successful until you feel trapped. If housing stays near 30% of take-home, you may feel modest, but you'll build wealth faster, invest consistently, sleep better. Take opportunities, handle shocks calmly. That's real ownership. Here's the final truth most people don't want to hear. Your salary does not determine what you can afford. Your cash flow discipline does. Two people earning $150,000 can live completely different financial lives based on housing choices alone. One buys a $700,000 house and feels pressure. The other buys a $425,000 house and quietly builds a seven-figure investment portfolio over time. Same income, different outcome. Real estate can absolutely build wealth, but only if it doesn't consume the capital required to build wealth elsewhere. So before you fall in love with the granite countertops, run the full calculation. Use net income. Cap housing at 25 to 30% of take-home. Stress test the downside. And remember, the best house you can afford is the one that still lets you invest, pivot, and breathe. That's how much real estate you can really afford.